High-yield savings and CDs, the traditional savings account, often linked to your checking, typically offers interest rates so low they barely keep pace with inflation. But a modern solution has emerged, the high-yield savings account, or HISA. These accounts, predominantly offered by online-only banks, leverage lower operating costs to pay significantly higher interest rates than their brick-and-mortar counterparts. This makes HISA an excellent place for emergency funds, short-term savings goals, or any cash you want to keep liquid yet still earning. Your money remains accessible, ready for withdrawal at any time, all while accumulating interest at a competitive, often fluctuating, rate. For funds you know you will need for a specific period, certificates of deposit, or CD, present another option. When you open a CD, you deposit a set amount of money for a fixed term anywhere from a few months to several years. In exchange, the bank guarantees a specific, fixed interest rate for the entire duration. The trade-off for this guaranteed return is liquidity. Should you need to withdraw your money before the term ends, you'll typically incur an early withdrawal penalty, often sacrificing a portion of the interest you've earned. CDs are often chosen for money earmarked for future expenses, like a down payment several years away, or simply as a way to lock in a favourable rate when interest rates are expected to fall. They typically offer slightly higher rates than HISA for longer terms, rewarding commitment. Both high-yield savings accounts and CDs serve as foundational tools for growing your money, siding alternatives far more productive than simply letting cash sit idle in a checking account. Understanding when to use each can significantly impact your financial growth. Dividend investing. Many investors chase growth, hoping their stock picks will skyrocket. But another, often steadier, path exists: dividend investing. Imagine a company earning profits. Instead of reinvesting every dollar back into the business, they might choose to distribute a portion of those earnings directly to their shareholders. This distribution is a dividend. It is essentially a reward for owning a piece of the company, a tangible return on your investment, separate from the stock price appreciation or depreciation. Companies typically pay dividends from their free cash flow. Established businesses, often with predictable earnings and less need for aggressive expansion, frequently adopt this practice. For an investor, these payments can become a consistent income stream. Think of it like rent from a property you own, but instead of real estate, you own shares of a publicly traded company. This regular cash flow can be especially appealing for retirees seeking supplemental income, or anyone looking to build a portfolio that generates wealth without selling off their underlying assets. The real power of dividend investing often comes from reinvestment. Instead of taking the cash, investors can use those dividends to buy more shares of the same company, or other dividend-paying stocks. This strategy creates a compounding effect. More shares mean more dividends in the next cycle, which then buy even more shares. Over decades, this snowball can grow significantly, transforming small, consistent payments into a substantial engine of wealth accumulation. It shifts the focus from short-term market fluctuations to long-term income generation and portfolio growth. Understanding this mechanism is key to appreciating its potential. Rental real estate. Rental real estate forms a cornerstone of many investment portfolios. Its premise straightforward: providing shelter or commercial space to others in exchange for regular payment. For countless individuals and families, renting offers flexibility, while for property owners, it represents a potent path to income and long-term wealth accumulation. At its core, this involves purchasing a home, apartment building, or commercial unit, then leasing it to tenants. The primary financial benefit comes from consistent rental income, which, after covering expenses like mortgage payments, property taxes, insurance, and ongoing maintenance, ideally leaves a reliable cash flow surplus. Beyond this monthly stream, investors also anticipate property appreciation. Over time, the value of the real estate itself often increases, building equity and providing a substantial capital gain upon sale. Some tax advantages also come into play, allowing depreciation deductions that can further improve returns. However, the reality of rental real estate extends beyond just collecting checks. It demands active management and consistent oversight. Landlords must navigate the complex process of finding and vetting tenants, drafting lease agreements, handling repairs promptly, addressing disputes, and staying compliant with local housing laws. Vacancies, unexpected major structural repairs, and challenging tenant situations can quickly erode profits and test an owner's resolve. This is an investment that requires significant capital, a tolerance for risk, and a willingness to commit time. Despite these complexities, the fundamental human need for shelter, combined with consistent population growth, ensures a persistent demand for well-maintained properties. This makes rental real estate a durable asset class, one that continually shapes urban landscapes and individual financial futures, often serving as a tangible hedge against inflation. Yet, understanding its true implications goes far beyond simple cash flow. Real estate investment trusts rate. Imagine owning a piece of a skyscraper, a mall, or even a data center without buying the entire building. This is the promise of a real estate investment trust, or REIT. REIT are companies that own or finance income-producing real estate across a range of property sectors. Think apartments, offices, warehouses, retail centers, even cell towers in timberland. They function much like mutual funds, but for real estate. Investors buy shares in the REIT, and that capital is pooled to acquire and manage a portfolio of properties. For the everyday investor, REIT offer a way to participate in large-scale real estate projects that would otherwise be out of reach. You gain exposure to the real estate market without the burdens of direct property ownership, like maintenance, tenant issues, or finding buyers. What income? By law, REIT must distribute at least 90% of their taxable income to shareholders annually as dividends. This structure often translates to a steady stream of passive income, derived primarily from rent collected on their properties. They are also liquid, unlike physical real estate. Shares trade on major stock exchanges, meaning you can buy or sell your investment with relative ease, offering flexibility traditional property investment lacks. So, whether you're looking for portfolio diversification or reliable income stream, REIT intersection of real estate access and stock market convenience. They transform bricks and mortar into readily accessible financial asset, fundamentally changing how many approach real estate investment. Peer-to-peer lending. Imagine a world where you could borrow money directly from another individual or lend your own savings to someone in need, all without the traditional bank acting as the middleman. This is the core idea behind peer-to-peer lending, a financial innovation that gained significant traction in the 21st century. At its heart, P2P lending connects individual lenders, often seeking better returns than conventional savings accounts, with individual borrowers who might be looking for more flexible terms or lower interest rates than a bank can offer. These interactions happen not on street corners, but through specialized online platforms. These platforms serve a crucial role. They vet borrowers through credit checks, assign risk ratings, process loan applications, and manage the collection and distribution of payments, often taking a fee for the services. For a borrower, P2P can unlock access to credit for personal loans, small business funding, or even debt consolidation, sometimes at more competitive rates. For lenders, it presents an opportunity to diversify their investment portfolio and potentially earn high yields by taking on a managed level of risk. However, this direct connection also means direct exposure to that risk. Unlike traditional bank deposits, P2P loans are not typically insured by government bodies. The borrower's default directly impacts the lender's return, a stark contrast to the pooled risk of a bank. This fundamental shift in responsibility reshapes how individuals engage with credit, moving beyond the established banking infrastructure. It places the decision of who to trust, and with how much, directly into the hands of a broader public, raising new questions about financial access and accountability. Affiliate marketing often operates invisibly, woven into the very fabric of the modern internet. It is a performance-based partnership where businesses pay individuals or other businesses a commission for generating sales, leads, or even just qualified traffic. Think of it as a digital salesperson working entirely on commission. Here is how it typically functions. A content creator, influencer, or a website publisher, known as the affiliate, promotes a merchant's product or service to their audience. They do this by embedding unique tracking links within their articles, videos, social media posts, or email newsletters. The crucial element is this link. It contains a specific identifier that tells the merchant exactly which affiliate sent the customer. When a user clicks one of these links and then completes a predefined action, most commonly making a purchase, but sometimes signing up for a trial or filling out the form, the affiliate earns a percentage of that sale or a fixed fee. The tracking system, often relying on cookies, ensures that the affiliate gets credit, even if the customer doesn't buy immediately, but returns days later. For the merchant, this offers a remarkably low-risk advertising model. They only pay when a specific, measurable outcome occurs. For affiliates, it provides a powerful way to monetize their audience and content without the complexities of product creation, inventory management, or direct customer service. This model extends far beyond individual bloggers recommending their favorite gadgets. Major e-commerce platforms, software companies, travel sites, and even financial services utilize affiliate programs extensively, turning trusted voices and digital spaces into powerful distribution channels worldwide. But seemingly simple, ubiquitous transaction lies a constant challenge, maintaining authenticity and transparency in a world where every click can translate into revenue, creating a complex interplay of trust and commerce. Digital product sales. Digital product sales represent a fundamental shift in commerce. Instead of tangible goods, creators offer intangible assets, software, ebooks, online courses, digital art, music, or even website templates. The appeal is clear. There's no physical inventory to manage, no shipping costs to factor in, and no storage required. This dramatically lowers overheads for sellers, allowing for higher profit margins and greater scalability. A creator can design a single ebook or develop a piece of software once, then sell unlimited copies worldwide, often with instant delivery. This global reach is a powerful advantage. Platforms like Gumroad, Etsy, or specialized marketplaces for stock assets and online learning facilitate these transactions, connecting creators directly with the massive audience. Even independent artists and educators can build entire businesses around digital offerings, bypassing traditional gatekeepers. However, selling digital products isn't without its own set of challenges. Success relies heavily on effective marketing, building trust, and demonstrating the value of something you can't physically touch. Competition is fierce, intellectual property protection becomes crucial, and products often require updates or ongoing support to remain relevant. The perceived value of a digital download versus a physical item is also a constant consideration for pricing strategies. This model empowers creators by removing physical barriers, but places an even greater emphasis on innovation and connection. It reshapes how we define ownership and value in the digital age, inviting us to consider what truly constitutes a product in a world of infinite copies. YouTube ad revenue. The financial engine driving YouTube's creator economy is its advertising system. When you watch a video and an ad plays, that transaction forms the foundation. Advertisers bid for placement on videos relevant to their target audience. YouTube, acting as the middleman, then matches these ads to viewers based on complex algorithms that consider demographics, watch history, and video content. This system isn't about fixed payments per view, it's dynamic. A key metric here is CPM, or cost per mil, which signifies how much advertisers pay for 1,000 ad impressions. This figure fluctuates dramatically. A viewer in the United States watching a finance tutorial might generate a significantly higher CPM than a viewer in a different region watching a gaming compilation. Factors like the viewer's location, the seasonality of advertising budgets, holidays often mean higher bids, and the advertiser's industry all play a role. Once an ad plays and generates revenue, YouTube splits it with the creator. For most channels in the YouTube Partner Program, this split is 55% for the creator and 45% for YouTube. This share applies to revenue generated from various ad formats: pre-roll, mid-roll, post-roll, and bumper ads. So, while it seems straightforward, a creator's actual earnings per thousand views can vary dramatically, even within their own channel, depending on who is watching, when they are watching, and what ad happens to be served. Understanding this variability is crucial for any creator seeking to build a sustainable income stream on the platform. Content licensing. At its core, content licensing is permission. It's a framework that grants one party the right to use intellectual property, be it a photograph, a piece of music, a video clip, or even a written article, created by another. Think of it as renting a specific right, rather than buying the item outright. This arrangement allows creators to retain ownership of their work while enabling others to utilize it for a defined purpose and paid, ensuring they are compensated for their efforts. Licensing contracts specify crucial details: how the content can be used, where it can be distributed, for how long, and for what fee. A music producer might license a track for a film soundtrack, limiting its use to that specific movie and associated promotional materials for a set number of years. A stock photo agency offers licenses for images with broad commercial applications, often tiered by resolution, audience size, or print run. These agreements are the bedrock of countless industries, from publishing and advertising to film and gaming, allowing creative work to circulate legally and generate revenue for its originators. This system prevents unauthorized duplication and distribution, protecting artists and companies from exploitation in an increasingly digital world. For a brand launching an advertising campaign, acquiring the correct licenses for every image, sound effect, and font is essential. It safeguards them from future legal disputes and potential financial penalties. Yet, as content flows across an ever-expanding array of platforms and international borders, defining the precise scope of these permissions becomes an increasingly intricate challenge. How do we ensure these vital protections keep pace with technologies that blur the lines of creation and consumption? Vending and ATMs. The idea of self-service, machine-driven transactions has a long history, but its modern form truly took shape with vending machines. Initially, these were simple coin-operated boxes, dispensing anything from postcards to stamps. The real innovation wasn't just automating a sale, but trusting a machine with the transaction. It removed the need for a human attendant, offering instant gratification at any hour. This concept of automated exchange laid the groundwork for a far more significant development, the automated teller machine, or ATM. ATMs arrived in the late 1960s, a radical concept. Instead of waiting in line at a bank during limited hours, customers could access their money anytime, anywhere. This wasn't just convenience, it fundamentally changed banking. It decentralized access to funds, giving individuals unprecedented control over their finance, 24 hours a day. Suddenly, the bank was no longer confined to a physical building and business hours. It was a network, accessible on street corners, in shops, and eventually, across continents. Both vending machines and ATMs share a core principle: they automate a single, specific financial interaction. One dispenses goods, the other dispenses cash. They redefined the relationship between consumer and service provider, proving that complex transactions could occur reliably without human intervention. This shift in trust, from person to mechanism, opened doors to a world where automated services now extend far beyond the snack and a $20 bill. What happens when every interaction becomes this automated? Royalties. Royalties represent a fundamental payment structure within the creative and intellectual property world. They are sums paid to the owner of a right, be it a patent, a piece of music, a book, or a brand, for the ongoing use of their asset. Think of it as renting out your creation, with each use generating a fee. For an author, this often means receiving a percentage of the sale price for every book sold. A musician earns a tiny fraction each time their song is streamed, played on the radio, or used in a film. An inventor might license their patented technology, collecting a fee for every product manufactured using their design. These payments are crucial. They ensure creators continue to benefit from their work long after the initial effort of creation. Terms of royalty agreements vary widely. Some involve a fixed amount per unit, others a percentage of revenue, and in certain industries, it can even be a share of net profit. These agreements are meticulously negotiated, forming the financial bedrock for artists, writers, researchers, and innovators. Without royalties, the incentive to create, publish, or invent would diminish significantly, as a single upfront payment might be the only compensation for a lifetime of work. This delicate balance of ongoing payment not only sustains individual creators, but also fuels the industries built upon their ingenuity. Software as a service SaaS. Imagine a time when acquiring new software meant a physical box, a CD-ROM, or a complex installation file. You purchased that copy outright, but you were also responsible for its maintenance, often buying expensive upgrades every few years. This model, once standard, began its dramatic shift with the rise of software as a service, or SaaS. Instead of owning the software, you subscribe to it. The application doesn't live on your computer, it operates in the cloud, accessed through your web browser or a lightweight dedicated app. This model fundamentally changes how we interact with technology. The SaaS provider handles everything: hosting the servers, managing the databases, performing seamless updates, and fixing bugs behind the scenes. You simply log in and use the latest version, typically paying a recurring monthly or annual fee. Think about the tools you likely use every day. Email services like Gmail, collaboration platforms like Slack, or even popular streaming services operate on a similar subscription principle, delivering content and functionality over the internet. Businesses widely adopt SaaS for everything from customer relationship management to project management and enterprise resource planning. Salesforce, Zoom, and Microsoft 365 stand as prime examples. For users, SaaS offers unparalleled accessibility. You can work from any device, anywhere, provided you have an internet connection. For companies, it eliminates the need for large upfront capital expenditures on software licenses and infrastructure. This model shifts the burden of IT maintenance from the end user to the service provider, allowing businesses to scale their software usage up or down as needed, without heavy investment in hardware or personnel. This transformation from product to service didn't just change how we buy software, it reshaped entire industries, fostering a continuous development cycle and demanding constant innovation from providers.